Hi, folks. This is Sean Hyman, and I wanted to talk to you today about an indicator that I use in conjunction with watching stock markets. This is the S&P 500 up here, and this is the VIX down here, which is called the volatility index. You can go to a site like stockcharts.com and put in $VIX and pull this up just like I have here. This is a 3-year chart that I'm looking at. And this is an incredible tool because it helps you to tell when volatility is low and when volatility is high. And it actually has a reverse effect. In other words, when volatility gets extremely low, which are readings typically, I would say below 18, you want to get cautious that there could be a stock market top nearing. It doesn't mean that you need to sell out all of your assets or anything like that, but it probably means to stop your purchases, tighten up your stops. If there's any good profits you want to take, you can probably take part of those, but it does not mean that the market has topped for sure, but it means that you're in the ballpark of a topping area, and it means that probably most of the gain that you're going to get out of this latest move is gone, and so your risk to reward flips to where there's a lot more risk of downside than reward of upside when the VIX gets below 18, particularly when it goes to 16 or 15. When it goes to 16 or 15 and gets really low, then you know that there's a huge chance of a market correction within usually 30 to 90 days. And then when volatility is very high and it just shoots and spikes up, of course that's when you have your huge market corrections, and it scares everybody out of their wits, and you can't hardly get anybody to buy in. And this shows the emotional fear in the markets when things get very high. So above 30 really is when things start getting a little crazy, but you want to just let the VIX go until it starts to peak out and calm back down before you typically enter into fresh buy positions in the market. You'll see here the VIX tops here and it starts on its way down, and you get a bottom. It start of a bottom fairly immediately, but the best bottom really is almost 30 days later. Here you get a spike up on a mini bottom, and about 2 weeks later you get a good buying opportunity. Here's where you get your VIX spike, and then about 30 to 45 days later is your best bottom. But you'll notice that anywhere in this period was a bottoming phase after the VIX peak. So the point is, you don't have to get in a super hurry. You can allow this thing to peak, hit its high, and start working its way down before you start buying and nibbling away. And the reason why I bring this out, the currency angle on this is that, of course, riskier stocks tend to do better when U.S. stocks are headed higher. And defensive currencies tend to do better when stocks are headed lower. So the dollar, the yen, some of those defensive currencies tend to do better when the U.S. stocks are actually heading lower and the VIX is heading higher. And the riskier assets like the Aussie dollar, Canadian dollar, New Zealand dollar, some of those, British pound, for instance, those tend to do better when U.S. stocks are heading higher and volatility is heading lower. So you can use this for your currency trades and in currency investments, as well as protecting and knowing better times to be buying in and better times to be holding the fort when it comes to your stock portfolio as well. So when the VIX is high, that's your better times to be buying in after the VIX peaks, and it's better to be stopping your purchases and tightening stops and possibly even taking some profits when the VIX gets below 18, particularly if it gets below 16, 15. And so this is just some ways to know when it's better to be on the defensive or on the riskier side of things. And so, again, when stocks are headed higher, the more aggressive, riskier, or risk-on assets tend to do better. And when stocks are plummeting, the defensive assets, the defensive currencies tend to do better. And the VIX gives us an idea based on where it is and how it's trading as to what the likelihood is of a stock market downturn or a stock market turn up. Stocks tend to turn up after the VIX peaks, and they tend to turn down after the VIX bottoms. Thanks so much for watching. Bye-bye. Oh, and also, click on the link below, and you can find out more about my trading service as well. Thank you. Bye-bye.